26 years of CNBC-TV18.
Well, as promised, let's focus on the IPO corner then. We have Park Medi World, which operates the Park hospital chain across North India. That opens up for public subscription later today. The company is looking to raise 920 crore rupees. The price band is fixed in the vicinity of around 154 to around 160 rupees per share. The IPO, well, to give you a brief detail about the breakup, it comprises of a 770 crore fresh issue and around 150 crore offer for sale. To understand the utilization of these proceeds and the way ahead, we're joined by Mr. Sanjay Sharma, the Group CEO and Whole-Time Director. Good morning, Mr. Sharma. Thanks a lot for speaking to us here on CNBC TV18 and wishing you all the best with this particular issue.
Good morning, and thank you so much to you for inviting us, sir, and thank you so much for your viewers to listening to us.
Well, it's a pleasure, sir, and they've all tuned in. So let's get a couple of details out of the way. 770 crores is what's going to be coming back to the company. That's the fresh issue. Out of that, I understand the 380 crores is going to be used for debt repayment. Fill us in with a brief detail. Post this repayment, what is the net debt number likely to look like? Point number one. And since you're paying up close to around 380 crores, interest saving will be in the vicinity of 35 to 40 crores or more?
Yeah, roughly, sir. See, the criteria is currently the entire debt is about 425 crore, which is from the banks. And we have an FD, which is unencumbered, about 305 crores. So total debt roughly turns out to be about 125 crores, if effectively we see. But post IPO, we are looking at retiring about 380 crores from that. And the capex amount, what we intend using for equipments and others is about 88 crore. And general corporate purposes is what we are keeping for about 302 crores.
All right. So basically, you'll become a net cash company post this IPO. Is that correct?
Yes, sir.
And I guess you'll be paying interest only on the 150 crores. So effectively, the interest saving will be around 15 crores approximately. Will that be fair to say?
Very right, sir.
All right. And you're saying that some part of the money is going to be used for capex as well. I understand that the number of beds has moved from around 2,500 to around 3,250. You can update me on what's the recent number. And what is the target capacity that you're looking at? And will it be mostly in North India, or are you looking at spreading your wings a little bit more and going more pan-India?
Okay. Currently, we are present in North India in 4 states. And with the bed capacity of 14 hospitals and bed capacity of 3,250 beds. But we are looking forward to increase the bed capacity. Roughly, if I tell you, 300 bed capacity in FY26, 750 in FY27, and 600 in FY28. So the total bed capacity increment will be about 1,650 beds, and the total number will be 4,900.
Okay. And the last point, which my colleague asked, in North, or will you spread out as well, sir?
Okay. So currently we have large scope in North of India. Our approach of expansion is basically in a cluster format. So we look forward to first consolidate in North India initially. And currently we are present in 14 districts. There are about 174 districts which require a model on the affordable side like ours. So we intend to first consolidating in North India and then subsequently spreading our wings to East, West and South.
Okay, there's enough scope there. Mr. Sharma, morning, Prashant here. You know, 2 things. One, a revenue growth over the last 3 years is about 5% CAGR or something, right? I mean, so it's kind of tepid. Just, I mean, on that, if you can comment. And what is the dependence on CGHS and government patients on government schemes? I think that is very high, right? And is there a issue then with regards to when, when the money comes in from the government? What are the dependents first?
The criteria is this, that our payer mix currently is about 84% coming from the government insurance and 16% coming from private insurance. The distribution payer mix is such. But out of 84% also, 92% is from the central government. So which is like a sovereign bond. The payment cycle is about 4.5 months, and it is a very structured, formatted system, which is faceless, contactless, without any human intervention. And automatically the flow comes across in that manner after 4.5 months.
But Mr. Sharma, on CGHS, so it's good to know that you don't seem to be reporting any payment delays or any backlogs. You're saying within about 4.5 months, the money comes in automatically. But
Yes.
what's important to note as well is that CGHS has finally hiked rates after many, many years. And it's a pretty broad-based hike across procedures. How does that change your operational dynamics? Give us some sense, because your dependency is as high as 83-84%. What has this latest hike meant for you?
See, generally the central government hikes the rates or change of rate happens in about 2.5 to 3 years. But as you mentioned, you were very right. This time the hike has been substantial, nearly about 12 to 15%. But in our FY26 numbers, we have not factored in this number till yet. But subsequently, we will be having definitely good appreciation in the EBITDA otherwise.
So will the appreciation be to the same, I mean, roughly, I know there's a very broad kind of, way of looking at it. The added, thrust would be in the same vicinity of, say, 15%, because that's how much the hike has happened. You're saying 15-20%.
We'll be looking at it conservatively. We'll be looking at about 7.5%, just on the conservative side.
Okay. So in FY27 EBITDA, 7 to 7.5% of a kicker will come in just by way of the CGHS hike. The rest, of course, will depend on your operations and, what happens.
And the growth potential.
So just, what is your strategy going forward? Because the share of insurance right now is very, very low in the business. Share of insurance, I think, is just about 7.5%. Are you looking to change the mix?
Yeah, ma'am. As we are going forward, see, our growth verticals are 4, in fact. In the process, we have 14 hospitals which are at different maturity cycle. So the hospitals which are younger in age and where the occupancy is about 50-55%, the growth will come by ramping up the occupancy. In the hospitals which are matured and there is 75 to 80% of growth, the growth will come because we have taken a conscious decision of laterally shifting towards high-end tertiary and quaternary product mix like robotics. We are doing about 30-odd robotic surgeries in a month. We are doing about 650 cardiac interventions. We are doing about 350 assisted joint replacement and others.
Right.
And I'll just finish, sir, if you give me a second.
Yeah.
The third growth aspect will come from greenfield, and the fourth will be from brownfield acquisitions. So that will be the growth aspect which will carry forward.
Got that. Mr. Sharma, we'll leave it there. Thank you very much. Appreciate you coming on here on CNBC-TV18 and running us through some of the details with regards to this issue. Open all the best to you.
Thank you so much. Thank you so much. It's always a pleasure. And thank you to your viewers also and to you also for inviting us.
Thank you very much.